copper, this is a big one. And a lot of people who are following or watching this show right now, they probably have an interest in financial markets, and they've heard the saying that copper has a PhD in economics. And what that means is copper is a great bellwether for economic activity. And right now, copper is bouncing around the 200-day moving average. And the reason this is important is in prior four-year cycle resets. So in 2015 and then in 2018, copper broke down ahead of the broader market breaking down.
Hi, it's Greg Gornert, investment advisor with Canaccord Genuity Wealth Management and Gornert Wealth Management. Now, welcome to the channel where we help you make sense of the financial world. Now, today, as usual, we're going to be joined by Javed Mirza, Canaccord Genuity technical analyst. Javed, how are you?
I'm doing really well. How are you doing, Greg?
I'm doing fantastic. It's so great to see you again. You had some great comments. You did a technical note comment back November 7th. I just want to see how that's played out, because one of the key things you had been talking about was that you thought at that point the markets were kind of extremely overbought and you were looking kind of for a short-term pullback. Where do you see things going right about now?
Well, so we're partially right on that call. So what our call was is we thought that this week, and today as we're recording, it's Wednesday, just before the U.S. Thanksgiving holiday.
Yeah.
Historically, this is a really good week for equity markets. So given that historical trend, our view is that, look, we should see a rally this week, but our main point or big takeaway was that a lot of our indicators were starting to flash some warning signs. So and then basically as a result of that, we said, hey, look, we think that after this rally, the Thanksgiving week, there's a strong likelihood that we're going to see a 1 to 2 week corrective phase take hold. So looks like equity markets have already jumped the gun and we're already starting to see signs of that sell-off. So that strongly suggests we got another week and a half of downside here. We're likely to tag the 50-day moving averages on most of the major equity indices. So the NASDAQ, the Russell 2000, S&P 500, and TSX. So that's what we're seeing. And yeah, hopefully that helps answer your question there, Greg.
Yeah, I mean, the other thing that you put out there that I thought was really interesting is that you made the comment that you felt that tapering was priced into the marketplace, and that might give some tailwinds to some of the growth stocks and some of the gold names as well. Do you want to talk a little bit about that, or I'd like you to talk a bit about that?
Yeah, for sure. So this we put out that comment basically, I think 3 weeks ago, highlighting that commercial hedgers, they're typically known as the smart money, they were long bonds at that point, and of course, bonds and yields move inversely. So if bonds are going up, then that points to yields moving lower. So that was our view, that we highlighted to clients 3 weeks ago. And since then, we've had a really good run in a lot of these growth names. However, over the last week or so, we've really seen a lot of these growth names start to come under pressure. So you've seen the NASDAQ have a couple of red days here for the first time in quite a while. And the semiconductors as well are starting to see signs of weakness. So, we're seeing signs that growth is stalling, but whether this is part of a bigger peak or just because they've had such a good run and you're just seeing some consolidation, that is what remains to be seen over the next week or two.
Yeah. Now, going from your points about Dow theory, cyclically, where do you kind of see ourselves playing out I know you break down the market cycle into 4 phases.
Yep.
You had been saying that we're, kind of phase 3 right now.
Yep.
What's your outlook for that going forward? And are you cautious on things, or where are things playing out over the next little bit?
Yeah, so great question. So in our market cycle model, typically we highlight 5 different phases, and right now we're in phase 3, which is the market top. So phase 3. Energy is running hot, basic materials are running hot, and we're seeing that, inflation has definitely been in the headlines. But remember, that's within the context of this, kind of secular bull market in equities that we see going out to 2030. So within that, you have these 3 to 5 year market cycles, and our work from a variety of different lenses, we've highlighted there's 5 different things that we talk to clients about that are suggesting that coming in the next couple of months is what we call the 4-year cycle reset. So that's the contraction phase of the business cycle. Today, I think the news was out that we just had the lowest number of jobless claims since the 60s. So everything's great. everything's awesome, but this is also the time where we get really cautious because, in our view, at the very least, the easy money has been made, and there's a strong likelihood, given that all our work is saying the same thing, is that we're in the market topping phase, and it's only a matter of time before we see this 4-year cycle reset, which is typically a 15 to 20% correction. Typically lasts anywhere from, call it, 4 to 6 months.
Yeah, it's so interesting. I guess I've been doing this long enough where whenever things start to feel really good, I get worried.
Yeah, I'm the same, and that's, it's. I mean, markets have been strong, no doubt, and the environment has been great for equities, but just everything that we're seeing strongly suggests. Look, I mean, like, energy prices are high, so that's a big input cost that's been rising. Yields are going up, and the equity markets can get through this, but just in general. We're getting to that point where things are going to be much more of a slog, and so at the margin, we're pretty cautious here.
Okay, now the other thing, you're keeping a close eye on copper prices.
Yes.
Yeah, so why don't we expand on that a little bit? And I want to talk to you about crude oil as well, and because that's another thing that you're keeping an eye on.
Yeah, that's great questions, Greg. You're really following my work pretty closely. That's excellent. So,
That's great work.
copper. Yeah, well, thank you. But copper, this is a big one, and a lot of people who are watching this show right now, they probably have an interest in financial markets, and they've heard the saying that copper has a PhD in economics, and what that means is copper is a great bellwether for economic activity, and right now copper is bouncing around the 200-day moving average. And the reason this is important is in prior 4-year cycle resets, so in 2015 and then in 2018, copper broke down ahead of the broader market breaking down. What I mean by breaking down is it moved below its 200-day moving average. So that's something we're watching very closely. There's there's a variety of other indices that we're looking at that are testing their 200-day moving averages. We've talked about this ARK investing, a lot of the growth areas of the market. That if you take a look at that ETF, it's been really hammered over the last week and a half, and all of these things are telling us that risk on growth are really coming under pressure. And copper, like I said, is another really big thing that we're watching for signs of this 4-year cycle reset coming into play in equity markets.
Interesting. Okay, so broader themes. We talked about the S&P 500. We talked about, we haven't talked about oil. Can we want to
Yes.
just move over to oil?
Yeah, so what we've highlighted just in our work is that over the last couple of months, energy and financials have been leaders. Now, energy, that's obviously predicated on the strength in crude oil. Financials have been leaders just because rates have been moving, and especially the 10-year versus 2-year spread, which is a good indication of that spread. The wider it is, the more money banks are making. So that's why a lot of financials have been doing really well. Our relative performance work is picking up financials and energy, and we've been highlighting this to clients for the last couple of months as two of the strongest sectors. But just in terms of energy, that works into phase 4 as well. And phase 4 is the first phase of the bear market. And that's because energy continues to run hot. But what we're watching for at the margin is basic materials tend to drop off before energy. So we're watching the healthcare materials ratio. That's a big thing that we're looking at. And once healthcare, and specifically in the US, because Canada, it's not as relevant, so it's not as defensive of a sector. But in the US, once you see that healthcare to materials ratio start to turn up, that's a strong sign that you're seeing a shift to defense. And we saw that last in 2018 before the 4-year cycle reset from October to December, but also in early 2020.
So broader themes going forward, just as we wrap up here, next 6 months or next 3 months before I see you again, what are you you think investors should be positioning themselves for?
Defense. We're getting close, in our view, to that 4-year cycle reset. I'd be looking at some more, like dividend-paying stocks, blue chip. I'd be looking to, at the margin, either put money to work there or to just leave some dry powder for once we work our way through the 4-year cycle reset.
Good. Hey, good advice. Thanks for joining me again, Javed Mirza. Thanks for watching. If you want to see more content like that, please consider subscribing or join me on my website, greggonert.com. That's greggonert.com. Look forward to seeing you there.